Well, welcome to this new episode. Today, I'm going to be discussing wholesaling. Well, basically, a whole lot of people have been trying to find out or trying to get into wholesaling. Wholesaling is actually a recruitment. If you're into recruitment, what a recruiter does is that he looks for a candidate that is looking for a job and then looks for an employer that is looking for a candidate or an employee. So he talks to the employer tells him all everything that they're looking for, the qualities, the specifications, the qualifications, the skill sets, and all that. So then he goes back to his database to look for the right candidate that actually matches what the employer is looking for. Then he debriefs the candidate and tells the candidate about the employer, everything and all that, and also discusses how much how much the employer is looking to pay for this position. So if the candidate agrees, now note that what the recruiter is actually telling the candidate is not the actual payment that the employer is actually going to pay. He still needs to, because it doesn't want to charge the employer for its services, and it doesn't want to come across as if it's charging the candidate who is actually looking for a job. So he doesn't want to charge him for his services too. So what the recruiter does is that it makes a markup from what the candidate wants to get and what the employer is willing to pay. So if the recruiter is able to talk to the employer and the employer says, okay, he's going to pay like $100 per hour. So what the recruiter needs to do is to go to the candidate and tells the candidate, look, the employer wants to pay you maybe $80 per hour or $70 per hour, so that it can try to make a markup once the process has been fulfilled. So if the candidate actually accepts $70 per hour, but the employer agrees to pay $100 per hour, so which simply means on this hiring process or on this recruitment process, the recruiter has made a $30 markup for himself, which is like his fee, an assignment finder's fee. Now let's bring this into real estate. You as a wholesaler, you're doing driving for dollars and all that. But in case you don't know what the driving for dollars mean, driving to dollars is simply just like what it means, what the name sounds like. You're simply just driving around your neighborhood to see distressed houses. The doors are broken, nothing seems to be working and all that. When you see those haunted houses, then you begin to think of, oh man, this might be a good property to look at. So what you do in this process is that when you find a house, a seller who is willing to sell a house, you ask the seller how much he or she is willing to sell the house. Maybe if they say they'll be selling the house for say $30,000, then you go to meet the buyer. It is very illegal to advertise a house that you don't have under contract. Yes, you cannot just go and put someone's house in the market without having it on contract. So what you want to do is, like, once you have actually identified the house and you've seen that the seller is actually motivated enough to sell the house, so you draw up a contract. I mean, there are a lot of contracts on the internet that you can actually use. So on the contract, it's simply going to say the name of the seller, your name. You put your own name as if you are actually the one buying the property. Okay. Then there's going to be a part on it that says the amount that you are offering, because you have to make an offer through the contract. So you put the amount that you are offering, but I is willing to sell for 50,000 and something, and you've done your comps. I'm still going to talk about all that later. You've done all your comms, and then you're able to talk to the seller to sell the house for $30,000. And the seller agrees. You put that on contract and you send the contract to the seller for them to review. And once they sign, you take the contract, you keep it. And then you go into the market. You can go to on Craigslist, on Facebook groups and all that. Put it on those groups, and then wait for a buyer to come up. So once the buyer show up, I mean, usually if it's a good deal, a whole lot of people will show up. They keep calling you. Your phone will blow up and all that. That's how you know it's a good deal. So now you're not gonna tell the buyer that you'll be selling the house for $30,000. This is actually, you have a contract with the seller, so you are actually the one. Legally, you are actually the one buying this house. But what you want to do is that on the contract you have with the buyer, you would have actually put like 30 days, because what you're going to tell the seller is that if I can actually close this deal in 30 days. But there's one money that you have to put down as part payment, just to assure the seller that you're a serious person, which they call earnest money. This earnest money can be between maybe $10 to $100. This is the money that you really have to give the seller at the point of making the contract. Once the seller signs the contract, you have to furnish the earnest money to them. That's going to show your own commitment on your part, and it's going to show your seriousness as to if you'll be closing the deal in 30 days as you've promised. So once you have the contract, once you have the house on the contract, you keep the contract, and then you post it on different platforms like Craigslist and all, Facebook groups and all that. So once a buyer shows up, but you definitely know that you're not going to post it for $30,000, since that is the amount that you already had the house on contract. So you want to actually have your own markup, because that is going to be your own fee. That is going to be your own gain or your own profit after the deal. Once the deal is done. So you want to add a little bit of markup, like say maybe on the deal you might decide for yourself how much you are making. You might say you'll be making like $10,000, $20,000, $15,000, $20,000. So if you say you want to make $20,000 on that deal, so all you need to do is just add $20,000 to the $30,000. So that means you're going to put in the house out for sale for $50,000 US. Okay. So having said that, so if once a buyer now shows up, you have to get them another. You can use the same contracts that you actually used with the seller. This contract are actually having the same fields. So you need to send the contract to the buyer too, and have them sign for the price of $50,000. And once you have the buyer signed, then you take the two contracts, you take it to the title house for closing, or a closing attorney. So once you give them the two contracts, the contract that you have from the seller and the contract that you have from the buyer, you take the two contracts, you take it to the title house. So they will now give the dates. They will now give out a date for both the seller and the buyer to come to the title house so that they can close. Prior to this date, the title house would have done their searches on the records to see if the house currently has liens, taxes, and all that. So they're going to discuss all this with the buyer, because the buyer is actually going to be, apart from the money that he is going to be paying to purchase the house, which is $50,000, he would also be signing that he will be taking care of all the taxes, closing fees. It all depends. That's actually between him and the seller, though, because some seller would prefer to, pay all their taxes and all that. But if in the case that the seller is not able to furnish the money for the taxes or liens owned on the property, the buyer would actually deduct it from all the money that is supposed to pay, that actually gets to the seller. So but that is not going to affect the wholesaler's money in any way. So what happens is that the title house will still keep your own $20,000 from the 50,000 paid for the deal. Now, from the $30,000 that the seller is going to make, they will now look at how much owed on the property and all that. So if it's actually owing the government taxes, lands of say like $5,000, so which simply means $5,000 would be deducted from the $30,000, which is actually pending for the seller for the deal to close. You cannot close a title deal with the pending liens or taxes. So everything has to be settled at the day of closing. So somebody has to bring the money. Is it that the seller brings the money out from nowhere, or the buyer takes it out from the money that is actually due to the seller? So once that closes, they transfer all the documents, title and everything, deed. So they transfer it to the buyer, and then the seller gets the check for whatever is actually left after paying all the taxes and liens and all that. And then they write you a check to you, the wholesaler. They write you a check of $20,000. In some cases, it's going to be the buyer that is actually going to pay the closing fees too. Why in some cases you might have to be the one, the wholesaler might have to be the one to pay the title house fees and all that. So is this legal? Yes, very legal. This is very legal in almost every country in the world. Why? Because this is an assignment of contract. A contract, you had contract with the two parties, makes it legal. You're representing the buyer, you actually the buyer actually with the seller, because it's actually your name on the contract, and you had it on the contract in your name. So instead of you now bringing out the money from your boss, you actually assigned the contract to another buyer, to another person, which is very legal for you to assign your contract to another buyer, who would then act in the capacity of you, which in this case acted in your capacity to purchase the house. In the case of the buyer, to you are actually the seller. Your name is actually on the contract as the seller. So the buyer has their own name and all that. So they are actually buying from you. The only thing is that at the title house, when everything closes, your own name would actually not be in the whole transaction. So the final transaction is going to reflect the name of the true seller and the true buyer. So the middle person name would be missing from the transaction history, which is definitely good for you. Like you're just a middle person. You only facilitated the seller and the buyer because you've already assigned your contract to a new buyer. So definitely you are out of the game, and nobody's gonna document that, which is very good though. So that is a simple way to explain wholesaling. So let me know if you have a question about this, and I'll be willing to do further discussion. And don't forget to follow me on this podcast, and then subscribe to my YouTube channel on Expand Income. Just search for Expand Income on YouTube and subscribe to it for more information and more podcasts like this. Thank you for listening. My name is Sean.